Hey everyone, let's talk about real estate in Las Vegas. First thing, I do want to give you a little apology. I do these market updates every month. I recorded the market update for February. However, I never got through the editing process, and so I never uploaded the February video. If you really want to know the numbers for January, let me know and I will send those to you specifically. Okay, so anyhow, this is the March update, March 2025 residential real estate market update for the Las Vegas Valley. Now, I want to do something a little bit different in this video from the way that I've formulated these videos in the past. If for those of you who've been watching for quite a while, you know that I always do a monthly, almost always, do a monthly market update for what happened in the prior month for single family residential resale. And I do a companion video for what happened in the prior month for condo and townhome residential resale, looking at each of those submarkets distinctly. Now, what I want to do, since we're into 2025, new year, I want to change this up just a little bit. I want to give you the market update information, but I want to provide you some additional insights that may actually be very productive for you with regard to looking for property or thinking about selling property. And so in this, which is the March 2025 market update, I'm going to start with this new feature. One other note, I've decided instead of having two videos, which clearly are overwhelming me in terms of the editing process and the uploading process, I'm going to combine the data back into a single video. So this is the market update for all three market segments. However, I will keep the market segments distinctive. Now, there's an advantage, as you'll see, as we're going through the data in this video, you'll see what that advantage is, and I'll talk about that by putting everything into a single video, in addition to perhaps some level of brevity. Okay, so let's go ahead and start with this new feature, which is how to think about certain issues that may be really impactful to you, to utilize those in the market for your own benefit, not just simply having good data, but actually having some particular insights. And so what I want to do is I want to start by talking about that. And I'm going to put it into the context of, you all know interest rates are really high. Interest rates have been really high since late April, beginning of May of 2022. In 2023, interest rates continued to go higher. In 2024, interest rates were approximately 7% all year. In 2025, we started at 7%. We came down very slightly through January, through February, most of February. We actually have come down a little bit further in the last part of February and through the first half of March. So we'll see what's going on. But generally speaking, interest rates are not going to be coming down, going lower than where they are right now, because the 10-year Treasury bond is trading at a particular interest rate, and the gap between 10-year Treasuries and 30-year mortgages does not shrink hardly ever below a 200 basis point or a 2% margin. So that means we're kind of stuck here at the current interest rate now, and I think over the course of the year, interest rates will be going back toward that 7% level. So, okay, with that note about high interest rates, that confirmation about high interest rates, I want to talk a little bit about the way in which you can overcome some of the affordability issues. So we know that 75 to 80% of people who are buying property are buying with a mortgage, which means they're directly exposed to whatever those mortgage interest rates are. And the higher those interest rates, that means that the property that one is buying, they're having to pay a higher monthly fee to acquire that property. So a house at $100,000, a totally fake house, at $100,000 at a 7% interest rate, that costs a lot more per month than if you bought that $100,000 house at a 3% interest rate, right? So interest rates actually impact affordability. Well, given that, and given that most people who are wanting to buy a property are actually have the hardest time, not with the monthly payments, but with coming up with the down payment. I want to talk about a way to overcome that problem. And I want to talk about why that may actually be really helpful to you, why it may be really significant to you, more so than you might have thought in the past. So we know that the conventional mortgage is a 20% down, 30-year fixed rate loan. So there's variations. There's adjustable rate mortgages where interest rates change after the first whatever period of time, 5, 7, 10. Traditionally, could be after a single year, whatever. So you've got 5-year ARMs, 7-year ARMs. The variation in the interest rate could change however many times per year. So once per year on a 7-year ARM would be a 7-1. It could change quarterly, so it could be a 7-4 ARM. Depends on what you're willing to do and a bank is willing to loan. You can also get shorter duration loans, like a 15-year fixed rate loan. Now that means you're paying off all of the principal over 15 years. It means you're going to be spending less overall in interest because you're not paying interest for 30 years. But it does mean your payments are actually going to be higher because, again, you're paying the entire principal, the entire amount that you borrowed over 15 years instead of over 30. Now, your payment's not going to be twice as high because your interest, the total interest is going to be lower, but your payment's going to be at least 50% higher than on a 30-year fixed rate loan. Sometimes you may be able to find a lender who's willing to write a 40-year loan. A 40-year loan means you're paying that principal over a much longer period of time, and so your payments are going to be lower. Yes, you'll pay more in interest over time, but it's a way to actually accommodate the buying activity, and it can be extremely valuable, although it's hard to find lenders who are writing 40-year loans right now. I think it'll actually become more common as we go through the next couple of years. But there's something else. Mortgages, conventional mortgages, requiring that 20% down, there's a way around that, right? So you could put down 10%, and some banks are totally fine with that. You could put down as little as 5%, and many lenders will actually lend you with a 5% down, but there's a catch. You're going to have to pay what's called private mortgage insurance, PMI. Now, let me just interrupt myself for a second and tell you, you could do 0% down on a VA loan if you're a veteran or active duty. You could do 0% down on a USDA loan as well if you qualify. That's going to be an incredibly hard thing to qualify for in Las Vegas. You could do 3.5% down on an FHA loan. FHA loans can actually be great because you don't have to put much down, but they can also be really expensive loans. But on a conventional loan, you could put 5% down. That's just scarcely more than 3.5%. You have to pay a PMI. Now on an FHA loan, you're actually paying insurance as well. You're paying it differently. It's not called PMI. So it's not an advantage to you to do an FHA loan vis-a-vis a 5% down conventional loan. But what's this PMI? What's it going to cost? Because maybe it's just, robbing from one side to pay the other side. Well, let's take a look at a specific example. In February, you could obtain a 30-year fixed rate loan for about 6.93%. So that's a percentage we're going to use for the 30-year fixed rate loan. Okay? And home prices, we'll see in a little bit, they were about $473,000 at the end of the month. That was the median sale price for a single family home. But let's just take a number of $480,000, okay? Because this is a little bit easier to work with than 473. Now, if you put down 5% on a $480,000 purchase, that means you're putting down $24,000. That's it. You're borrowing all the rest. $456,000 is the loan that you're borrowing, okay? At 6.93% for 30 years to the fixed rate loan, okay? But if you put down that only 5%, you're going to have to pay for private mortgage insurance. Now that PMI, technically you have to qualify for it. It'll be qualified through the same kind of, it's a separate, but same kind of underwriting process as the bank is going through to figure out whether or not they want to loan to you. And so you're not really seeing it visibly as a separate process, but technically it is. That means you're effectively buying insurance for 15% of the loan. Now that insurance that you're buying is going to come with a premium, like all insurance policies, your car policy, your health policy, your life policy, whatever. They come with a premium. How much is that premium? Because this is where it gets really, really interesting and really kind of surprising. The premium is going to be about $240 a month. It's going to be about 0.5% of the value of the loan. Okay. Now your principal and interest, the amount of principal you pay, the amount of interest you pay every month on that $456,000 loan to buy that $480,000 house, when you did 5% down, that's $3,000. I understand that might be a lot of money. It's just an example, right? You could do this on a less expensive property, on a condo, something like that. But $3,000 you're paying, and you're paying $240 a month in PMI. Okay. Now, here's where it gets interesting. Once you've gotten to 20% equity in the property, equity could occur because the prices go up. It could occur because you're paying down the loan every single month, not much at first, but you're paying down the loan every single month. That builds equity. It could be because you put some additional upgrades into the property, and that actually forces some level of additional appreciation. But once you get to 20% equity in the property, meaning the property is worth 20% or more above the value of the loan, you call up the bank and you say you'd like to have the loan recast. Recasting the loan, super simple. It's not a refinance issue. The loan terms remain exactly the same, but it allows the bank to with an appraisal, figure out if you've got 20% or more equity in the property, and if so, they eliminate your PMI. You don't pay to do the process. You'll have to pay for the appraisal. That's a couple $100, but that's it, right? So how long does it take to get to 20%? Well, if you put 5% down, the last couple of years, we've seen 5, 7, etc. percent increase in the value of the property, value of properties generally across the valley every single year. All right. So you put in 5%, and let's say a property goes up 7%. That's a nice return. That means you've already got 12% equity after just the first year. The truth is, in Las Vegas, you're probably looking at 3 years to be able to get from 5% to 20+% equity in your property. That's it. 3 years. So let's go back and think about what this payment is you've been making for the PMI insurance. $240 a month for 12 months a year. And for the example I'm giving here, I'm going to be really conservative and say it takes a whole 4 years to get there. So 4 years. So that's 48 months, $240 per month. That means the PMI insurance cost you $11,520. That's not a nothing amount, $240 a month, $11,520, but it's actually a small amount. And let me point out to you just how small that amount is. If you had put down 20% for the purchase of the 480 property, you would have had to put down $96,000. Now, you only put down $24,000. $24,000, that's a doable amount for most people. It may take some concerted effort. It may take some sacrifice for some people to save up $24,000. But it's a heck of a lot easier than saving $96,000, right? So putting in $24,000 means you did not put in $96,000. And that's $72,000 of money that if you had, you could be earning interest, you could put it in the stock market, whatever, or you didn't have the ability to put it there. Now, if we think about this, $72,000 you did not put in, and we subtract from that the $11,520 that you did put in for more PMI premiums, that still leaves you with $84,500. You've eliminated your PMI after 4 years. You've got 20% equity in your property, and you saved $84,500 in the acquisition, the total acquisition costs of the property, right? With 11,520 of those acquisition dollars actually having been spent over the course of 4 years instead of all up front at once, okay? So now let's think about, if you didn't do that, if you did not have $96,000 and you decided you did not want to pay for PMI, so you did not get the $480,000 house, what's the cost? Well, remember, equity had built over the 4 years. In fact, if we were thinking equity was building at kind of the background rate, right? Nothing special about the particular house, but as the market appreciates, over 4 years, the value of that $480,000 property will have gone up to $629,000. Oh, that's a lot. Try saving 20% of that to be able to get the loan, right? So PMI will become actually a more important thing as property prices continue to appreciate. But if that house went up to $629,000, and that's not a pipe dream, that's just regular background appreciation that we see in the valley year over year. That's not like the appreciation we saw in 2021 when prices went up 24% that year alone. It's not like what we saw in 2020 when prices went up by 10%. It's what we see in the valley is sort of 5 to 7% per year, normal appreciation if the market's behaving in a sort of a normal manner here in the Las Vegas Valley. That's $149,000 that, if you own the property, goes into your pocket. Of course, you have to sell the property to get it, right? So you got into the property for less than if you put down the 20%, including your premium for the PMI, the private mortgage insurance, and you got $149,000. Now let's think about that $149,000. One, the median income here in Las Vegas Valley is $60-something thousand. So let's just say $70,000. $149,000 divided by 70. Well, that's just over 2 years. Effectively, you were living in the house for 4 years. You're not paying a landlord, you're paying the bank interest, and you're paying for the insurance for that 4 years. And you've gained $149,000. If you make in a normal year $70,000, you were also paid by your house more than 2 years of income during that time. And wait, it gets even better, because the equity that you gained in your house is tax-free to you if it's a primary residence, up to $250,000. That's the tax code. You can take that as many times in your life as you want to, as long as you don't do it more than every other year. So you just got $149,000 of equity gain tax-free. Well, if you think about your $70,000 income, what was the tax that you paid on that? Maybe $14,000? So in 4 years, you would have paid $14,000 times 4 in tax off your $280,000. That's $70,000 times 4. So that would have been $56,000 off your $280,000. So that would have been $224,000 that you earned in income after taxes, and you earned another $149,000 through equity. That's almost 3 years actually worth of your income, right? So for living in the house for 3 of the 4 years, you were getting twice your income. You were getting additional payment to you, right? It's sitting in a savings account. You can't touch it. It's sitting in the equity in the house. You can't touch it until you sell or borrow against it. But you're effectively getting income that's of value to you that looks like 3 years of income over that 4 years. Now, if you didn't buy the house, you don't get that. If you're renting, you don't get that. That's why I say that real estate is actually the most effective and the most common way within which people build wealth. You can only do that through real estate. Yeah, you could buy a lottery ticket and maybe you'll become a great big winner. This is just sitting back in your own house for a 4-year period of time that you got for just $24,000 down. So there's powerful ways to actually be able to engage in real estate, even if you hadn't thought you could, because we can do it with minimal amounts of down payment. Now, not every lender is going to have the ability to service everyone, right? If you want to be connected to some lenders, let me know. I've got various lenders here in the Las Vegas Valley. Obviously, you can go out and find your own, but PMI could actually be something of incredible value for you. Now, I will say, if you're not looking to buy a primary home, but you're looking to buy an investment property, interest rates are obviously high. Prices for homes have continued to go up throughout this period of time, as they do normally, which means that it's becoming harder to find cash flowing investment properties. So instead of doing something with minimizing your down payment, you actually want to maximize your down payment as an investor. So this is contrary advice for, depending on what it is that you're trying to do in the buying of the house. If you increase your down payment to 100%, right? There's no loan, whatever, your cash flow will be great because you're not paying anything on the house any longer, but you're not using any leverage. If you have to pay over 50% in cash, you're probably so far under levered that it's not going to be a particularly great return on the investment that you're making. You'll cash flow, but the return on the investment is not going to be great. We're looking now in the Las Vegas Valley for most rental properties. If you're buying single family home as an investor, you want to be putting down 30 to 40%, somewhere in that range, to make sure that you're able to cash flow, to make sure that you've got positive cash flow every month coming in. So depending on what kind of buyer you are, looking at primary or looking at a vacation home or looking at a second home or looking at an investment property, the advice will change, right? And make sure you're working with a real estate agent who can advise you depending on what kind of a buyer you actually are. Similarly, with what kind of a seller you actually are. If you're thinking about selling things, the advice changes depending on what your goals are, but also depending on what it is that you're trying to accomplish through real estate. Okay, so that's the insight that I wanted to provide for this month's video. Now let's go ahead and talk about the market update. Okay, so first thing I want to look at is prices. Now remember, I'm going to look at each of the submarkets. I'm going to look at them individually here. So we're going to look at the February numbers. This is March update, so we're looking at the full data from the month of February. The data were pulled on March 7th. So this is resale only. I parcel out all of those that are new construction that somehow make it into the MLS because they're deceptive, they're a different population, and they actually prevent us from understanding what's going on in the resale market. So resale only, pulled on March 7th, as I pulled the data all the time on the 7th of the month, and we're going to look at each of the individual submarkets here. So our single family residential, $473,000. Now this is actually flat from the a couple dollars less, like $472,995 that we saw in January. So basically flat to January. This is, however, up 8.2% year over year. So that means from February numbers of 2024 through February numbers of 2025. So that's 8% of appreciation that occurred, 8.2% of appreciation that occurred over the last 12 months. Now that's kind of interesting, right? Because I was saying in the insight example I was giving earlier in the video, normal appreciation sort of between 5 and 7%. We're running ahead of that over the last 12 months, right? So 5 to 7% appreciation, not in any way a pipe dream with regard to how houses appreciate here in Las Vegas Valley over time. 8.2% over the last 12 months. All right, so that's single family homes. What about condos? And this is where it gets a little interesting, because I'm going to have single family, condo, and townhomes data for each of these criteria as we go through the video, as we do this kind of monthly market update going forward in time. It's going to allow us to more easily compare across submarkets to see how, for example, houses might be doing relative to condos or something like that. All right, condos, median sold price for condos $240,000 in February of 2025. That's up $5,000 from what we saw in January. It's up 2.1% month over month. It's also up 2.6% year over year. So that's kind of interesting, right? We know that housing prices went up 8.2%. Condo prices throughout the past 12 months have underperformed single family homes. They've only gone up by 2.6%. We'll see some of the reasons why that may be as we go forward, but the condo market's become a little more challenging after having done really well coming out of the pandemic. And so part of it is that condos are just sort of regressing toward mean for normal growth over time. We'll see some more of that as we go through the rest of the data. Townhome prices, median sold price, $340,000. And it's up just barely. It's up $775 or 0.2% month over month, but it's also up 7.8% year over year. So that means that townhomes are just slightly underperforming single family homes. In fact, statistically, they're indistinguishable in this particular period of time from single family homes as to price appreciation, right? Just because there are fewer townhomes, it makes the comparison a little bit harder. So we need to see bigger swings in townhomes to sort of match what's going on in single family homes. But nonetheless, we're up 7.8% year over year for townhomes in the Las Vegas Valley. Now, there's another way I like to look at pricing. And in order to keep these videos of reasonable length, I'm not going to go into all of the details with some of the data as I have in the past, but there are some market insights I want to talk about. Price per foot specifically allows us to understand what portion, the upper portion, the lower portion of the market may be performing better. Now, I'm looking at this just for single family homes. Price per foot fell $4 month over month. What that suggests is that we're still seeing some resistance in the market. It's sort of that $1 to $3 million price strata, right? Above that, things are fine. It's always a slow market when you get above $3 million in Las Vegas. Below that is doing relatively better, and that's why we're seeing price per foot come down. So, okay, next. We look at sold, right? Because prices could do whatever if nothing actually sells. So we want to make sure that sales are taking place. Sold numbers for single family residential in February of 2025, 1,574. That's up 145 houses from what we saw in January. That's kind of weak growth, but it's actually because the numbers are relatively small right now. That's actually growth of 10.1% in total number of units sold for single family resale residential. So that's kind of interesting. We are up 19.6% year over year. Right? 2024, remember, was just tiny bit stronger than 2023, and 2023 was the weakest year we had for transaction volume in the Las Vegas Valley going back into the 90s. And so that we're up a lot from 2024 at this time of year. That's great news, but read it with a grain of salt. It does not mean we've got large numbers of transactions taking place here. But it is nice that we've come up from January. Kind of in a seasonal manner. Condos, 238, up 40 units from what was sold in January to February. We're up 16.2% month over month. We're down from the beginning of 2023. We're down 5.1%. I'm sorry, 2024. We're down 5.1% year over year. Now, remember last year condos were relatively strong, and so that's why we're seeing weaker price appreciation and weaker sales right now. We're kind of making up for the condo market getting ahead of the other submarkets. What about townhomes? Townhomes 196, that's up 33 units in February from January, or up 20.2% month over month. So that's healthy. It's actually kind of in line with normal seasonal trends for this time of year, so you don't get too excited about it. Now we are up 18.8% year over year. So that's good. We're looking to be on track for normal seasonal growth in transactions, but we're coming off a low base. Insight, pending contracts. Those are contracts that have been written but not yet closed. Pending contracts went up in all three submarkets. In fact, they went up fairly strongly, so that's a good indication for what may happen in March. So that's a highlight here. Now, there's one other type of sale I want to talk about just for a minute here, because this is interesting, and lots of people are, oh, this is the way you're going to make money in the market, and blah blah blah. And I want to point out to you how silly it is, right? And it's a serious subject, so I don't mean to belittle the subject, but let's look at foreclosure sales. Foreclosure sales in February for single family resale, 0. Foreclosure sales in February for condos, 0. Foreclosure sales in February for townhomes, 0. And by the way, that is no change from January. In January, there were 0 single-family residential resale units that had gone through foreclosure and sold. 0 condos and 0 townhomes. That's 2 months in a row. That's a sixth of the year of 2025. We already have under our belt 0 foreclosures. If you're thinking about waiting for a foreclosure, you're going to get an amazing deal, blah, 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 that's your way to get rich, ain't going to happen. By the way, real estate's not a get rich quick kind of thing. It's a get rich slowly. You'll build wealth over time. It's a great vehicle to build wealth. It's not going to happen overnight. It's not how real estate works. But you can miss wealth building by not participating or waiting around for silly things that just are never going to happen. Right? You can get into it maybe using PMI. And by the way, I don't really like insurance, right? So having to say buy private mortgage insurance, that's a little bit hard for me. But in reality, it can be a real financial boon to you to engage in the insurance market in that particular manner, right? Those are the ways to get wealthy in real estate, is get into the game. Don't wait around because some idiot or some whatever was telling you, oh, you're going to get lots of these things. They're not happening. They're not happening. And the people who own those things that someone thought was going to go into foreclosure, if it's a single family home, they just made another 8.2% over the past 12 months, right? Because that's what the median price went up. Okay, so next, inventory. And this is where things become really problematic, and they've been problematic for a long time, right? They've been problematic since about October of 2020. Inventory. Single family residential resale homes listed on the market waiting for a buyer to come along. 5,363. That's down, it's down. In February, it's down 293 or 5.2% from what we saw in January. This number should be going up, right? Inventory should be going up in the spring, in the winter, the new year, the winter, the spring, the summer. It's going down. It's going down at the same time that we just saw single family residential sales go up by 10.1%. Inventory didn't go up. It went down by 5.2%. Now, inventory is up 22.4% year over year. Remember though, 2024 was a not great year. So the comparisons are a little bit challenging. Okay, condos. We did get a little bit of inventory growth. 1,329 condos for sale at the end of February. That's up 64 or 5.1%. It's up 42% year over year. Again, same caveat applies with regard to the year over year issue. Townhomes, 797, up 14 in a population area of 2.4 million people. 797 townhomes, up 14 in the month of February. That's up 1.8% month over month. It's up 58.4% year over year. Again, same caveat. So single family residential inventory came down. Condos and townhomes went up a little bit. But problematically, if we look at new listings, that's a seller decided, a potential seller decided, now's the time, I want to list my property for sale. Let me get into the market. And so they call up an agent, and they, maybe several agents, they interview them, they decide, okay, this is what needs to be done before you list your property, and let's go ahead and list now. And they've listed their homes, new ones. New listings were down in all submarkets. New listings were down in all submarkets. New listings should be going up strongly right now per normal seasonal patterns. Now, every year since the end of 2020, a lot of experienced agents and a lot of people listening to experienced agents, hoping that what they were saying was true, were saying, oh, normal springtime inventory builds, so that's great, we'll get lots of inventory. And I was saying, I don't think that's actually the pattern that we're in. We're not in a normal springtime building pattern for inventory here. We're in a highly constrained inventory environment, and I don't think it's going to get very much better. And I've been right in that call all the way from October 2020 through February 2025. Inventory has been sitting really at low levels. And it continues to be the case, and it's going to continue to be the case going forward in time until we see significant changes in interest rates to the downside. And that's not coming this year. There is some background talk that, hey, tariffs and deportations may be causing the economy to slow down, and that may cause the Fed to lower interest rates. Well, tariffs and deportations could definitely slow the economy, but they'll also increase inflation. So the Fed then has to decide, do we deal with slow economy as experienced by unemployment, which is different than slow economy and may not materialize, or do we worry about inflation? So there's a couple of people out there who have been talking about the prospect of stagflation. Stagflation means you've got high inflation and you've got high unemployment. And that's the hardest thing for the Federal Reserve to deal with, because the prescriptive measure for one is exactly the inverse of the prescriptive measure for the other. So the Fed finds itself in a hard spot. The Fed right now is still very much trying to control inflation, feeling that they could respond to unemployment if unemployment starts to go higher significantly. But where we are right now, high interest rates likely to continue going forward. Will we see a recession in 2025? I don't know, it's possible. There would be policy mistakes that cause it to happen if it does happen. But recessions happen. They're recurrent things that we see in the economy. And so nothing to be scared of. If you happen to become unemployed, obviously that's a really bad thing. If you happen to be paying more for things, that's uncomfortable. But that's where we are with high interest rates, and I do not foresee interest rates coming down significantly at all during the course of this year. Now, that's our inventory number, 5,363 for single-family resale homes in the Las Vegas Valley. again, with a population of 2.4 million people. It's not a really big number. It's a small number. It's less than half of what it should be. But I want to look at this inventory number from a different perspective. Okay, so we know the median sold price at the end of February was $473,000. So let's look at the inventory. The median house listed in inventory at the end of February was not $473,000. It was $560,000. That's $87,000 higher than the median sold price. Well, that's a problem. That's a problem because it means that a lot of the inventory is sitting there at too high a price. It's not going to sell, right? We know the buyers are already constrained by high interest rates and high prices. Inventory that's sitting out there at great big numbers, nice. It's sitting in inventory, but it's kind of illusory. It's fake inventory. So what we can do is we can normalize the listing data. We can pull the dollar figure down on the listing data. And if we renormalize it such that the median list price is $473, so that it's the same as the median sold price, that reduces inventory, changes the real number to 3,033. That means we only have 65% of inventory that's real. Of the 5,363, only 65% of them are real. What that means is inventory is less than 30% of normal. Inventory is not growing and doing great. Inventory is 30% of normal on a price adjusted basis. We've got very low inventory. And new listings down in all market subsectors, all submarkets in February. Well, it should be growing, right? Seasonal pattern, it's growing pretty strongly. Down. By the way, just as I'm pulling the data, an interesting note, there's only one single family resale in the entire Las Vegas Valley that's listed for less than $200,000. And there's only 13 more that are listed for less than $300,000. So if you're looking for a house and you want it to be like, $250, sure. Right. And of course, those ones that are listed at those prices, they're not the kind of place you'd want to live in, right? So median is $473,000. And if you're looking for a house, that's what you need to be basing your thought process on. You can find less expensive houses. There's 14 of them priced below $300,000, right? But there are, of course, condos, median price $240, and townhomes, median price $340. So there are options in the market. You have to figure out what's appropriate for your price range, what's appropriate for your needs and your desires to make sure that you can actually participate in the market. Now, one other piece of data that I like to give in all of the market update videos, and that is back on market. Back on market numbers, single family resale, February 2025, 596 failed contracts. Now remember, I call this failed contracts. In reality, failed contracts, there's not a good way to measure. The data is not produced as such. This is failed contracts that went back into the market. So this is a little bit of an undercount. I don't know how big the undercount is, but there are failed contracts that do not result in a property going back into the market, right? Those are not covered here. So this is back on market only. I'm referring to it as failed contracts. It's the overwhelming majority of failed contracts, but it's a slight undercount. 596, that's 27.5% of all single family residential resale contracts that failed during the course of February. And by the way I calculate that, just in case you want to calculate it on your own, because I know some of the viewers of this channel are actually other real estate professionals, and I've had questions sometimes, well, how in the world do you come up with that number? It's back on market divided by the sum of back on market and closed or sold units during the course of the month. Okay, so condos, 120 failed condo contracts in February. That's 33.5% of condo contracts failed in February. Townhomes, 71 failed contracts, that's 26.7% of all townhome contracts failed in February. These are pretty disastrous numbers, right? And it's not only here in Las Vegas. This is not a weird feature of Las Vegas market. This is happening throughout most of the country. And it has been happening throughout most of the country since since actually early 2020, right? 5 years now. These numbers should be well under 10%. And they're 2, 3 plus times that. These are really bad numbers. Make sure you're talking to your real estate agent, figure out why this is happening. Make sure they can explain to you why it's happening. Make sure they can explain to you how they'll prevent it from happening to you. I just had a closing just a couple days ago where we ended up in a problem with a lender, and we managed to work through it actually relatively quickly, but it caused a delay in the closing of the contract for a month. I ran into another one this past month where we're in contract on a purchase on a condo, and there's some technical issues that the lender's having, not with the borrower, that have caused a significant delay. There's a lot of challenges taking place in the market, making transactions harder right now. And if you've got an agent who does not know what they're doing, the challenging transactions are falling apart. And since the number of challenging transactions is elevated, have been for 5 years, those transactions are falling apart, significantly associated with the quality of representation you have in the market. Not completely, but significantly. Okay, that's it for the real estate market update for March of 2025 here in Las Vegas Valley, where I've looked at single family resale, residential, condo resale, and townhome resale. And I've also given you insights on how you may more easily participate in this market, whether you're a buyer of a primary residence or maybe a secondary or vacation home, as well as if you're an investor buyer. So I will see you next month. Remember, please, feel free to comment, reach out, but smash the like button, hit the notification bell, all those kinds of things you do on YouTube. And please share these videos with your friends, your neighbors, your family, your colleagues, anyone you think might benefit from the insights that are uncovered in here, the advice, the numbers, the actual knowledge of what's taking place in the real estate market and how to best arm yourself for the activities that you need to be engaged in real estate. Thanks.